Good morning, dears, and welcome to our today's session. And I welcome you all to the super coaching for UPSC by textbook. And our today's session, we meet here to discuss one of the very important topic of Indian economy, that is monetary policy. So we meet here to discuss monetary policy. So what is the meaning of monetary policy? As I said that there is money supply, and money supply, let me give you people the background, and in that order what we yesterday lecture we discussed that about the money supply. And what is money supply? Money supply is total money in the hands of people at a particular point of time. So and this is instrumental, and this money supply is instrumental for aggregate demand in the economy. And since money supply is instrumental for aggregate demand in the economy, so there is need to that money supply should be adequate in the economy. Neither there should be more money supply in the economy, at the same time there should not be scarcity of money supply in the economy. And RBI through their actions and activities maintains the adequate amount of money supply in the economy, and those actions or activities of RBI is known as monetary policy. I am going to repeat once again. As I said in last lecture that money supply is responsible for aggregate demand in the economy, because money supply is money in the hands of the people at a particular point of time, and that determines the aggregate demand in the economy. So if there is more than required money supply in the economy, it may lead to inflation in the economy, whereas if there is scarcity of money supply in the economy, it may lead to slowdown in the economy. So there is need to maintain adequate amount of money supply in the economy. So the actions or activities of RBI through which RBI want to maintain adequate amount of money supply in the economy, that is known as monetary policy. In other words, we can define it that monetary policy is nothing but component of economic policy of RBI through which it maintains adequate amount of money supply in the economy, or we can say that component of economic policy of RBI through which RBI regulates money supply in the economy. And as per RBI Act 1934, RBI is entrusted for monetary policy. As per RBI Act 1934, RBI is entrusted for the responsible for conducting monetary policy, and this act was amended in 2016 to give it a statutory framework. And the entrustment of RBI is that RBI will try to maintain the price stability. The main focus is that they will maintain the price stability. That means their main purpose of monetary policy is to maintain the price stability in the economy, meaning to control the inflation in the economy. But apart from that, RBI will also focus on economic growth. So if there is any conflict between the control of inflation and the economic growth, then RBI will definitely go for controlling inflation in the economy. That is the meaning. Entrustment, that is the meaning of statutory provision. That before that this responsibility was not having a statutory backward statutory responsibility, rather it was just a provision. Now it has been given a statutory provision, meaning this provision has been made by the act of parliament, by the act of parliament. So this is the meaning of, and we discussed it, and as per RBI Act 1934, which was amended in 2016, the central government officially notified in Gazette 4% consumer price index as the inflation target for the period of from 5th August 2016 to 31st March 2021 with upper plus minus 2%. That means ideally in the economy the inflation rate should be, and we identify consumer price index, that index, consumer price index or the inflation rate should be 4%, but plus minus 2%. That means maximum inflation rate in any economy, not any, rather maximum rate of inflation in the economy can be 6%, whereas minimum can be 2%. So that means the inflation rate from 5th August 2016 to 31st March 2021, it should be 2% to 6%. And from 1st April 2021, this same provision is again extended up to 31st March 2026. So I mean to say that as per the RBI Act 1934, which was amended in 2016, the inflation rate in the economy up to 31st March 2026 should be 4% plus minus 2%. That means the inflation rate should lie between 2% to 6%. This is the responsibility of RBI, and RBI want to maintain this inflation rate in the economy through their actions or activities. Those actions or activities are known as monetary policy. Those actions or activities are known as monetary policy. Now we are going to proceed further and we are going to discuss that objectives of monetary policy. That what are the objectives of monetary policy? As I said that in 1934 RBI Act 1934, it was mentioned that prime objective of the monetary policy is to have the stability in price. So the prime objective is price stability. RBI will try to maintain the price stability, meaning neither there should be inflation at the same time nor there should be deflation. That is the meaning of price stability. That means, and how they are going to maintain it? Through regulating the money supply, because money supply is instrumental for aggregate demand, and on the basis of aggregate demand only the prices are, demand is going to increase, and on the basis of that only the prices are going to increase. So the prime objective as per the RBI Act 1934, which was given the statutory recognition in 2016, the prime objective of RBI is just to maintain the price stability in the economy. At the same time, the other objectives of the monetary policy of RBI is, the other objectives of monetary policy of RBI is to have the economic growth in the economy. As I said that if money supply is less than required, that it will reduce the aggregate demand. If it will reduce the aggregate demand, the producer will reduce the production. If the producer will reduce the production, then the economic growth will be reduced. So this is also the responsibility of the RBI through the monetary policy to ensure economic growth as well. But that is the secondary objective. If there is any conflict between the objective of maintaining the price stability and objective of having the economic growth in the economy, then RBI will definitely go for controlling the inflation. Other objective of RBI is other objective of RBI is that to ensure the full employment. To ensure the full employment and maximum output, that means to have the economic growth. As I said that money supply is instrumental for aggregate demand, and if the money supply is increasing, and as the money supply is increasing, as the aggregate demand in the economy is increasing, as much the producer is going to increase the aggregate supply in the economy, is going to increase, going to increase the aggregate supply in the economy, then there is going to be, producer has this confidence that there is no scarcity of demand in the economy. So producer is going to increase the production. When the producer is going to increase the production, in order to increase the production, producer has to employ more employees. So employment rate is going to increase. If employment rate is going to increase, what is that means? Employees are going to have the purchasing power. So purchasing power in the economy is going to increase. If the purchasing power is going to increase, then aggregate demand in the economy is going to increase. If aggregate demand is going to increase, aggregate supply is going to increase, and then the production is going to increase. If the production is going to increase, economic growth is going to increase. So that means, just to ensure that neither there should be inflation, at the same time aggregate demand and aggregate supply shall increase simultaneously. That is also the objective of the RBI, so that RBI can ensure the full employment and maximum output. That is also the objective of RBI monetary policy. Now, other objective is to have the exchange rate stability. Exchange rate stability. RBI through their monetary policy also maintains the exchange rate in the economy. How they maintain? That whenever there is forex, whenever there is increase in forex, forex means foreign exchange. Whenever there is increase in forex, that means, suppose earlier there was 100 rupees dollar, $100, not 100 rupees dollar, $100, and $1 equal to 80 rupees. Now this forex increases 100 to $200, and the exchange rate is same. So that means now earlier, that when the $100 was there in the economy, the money supply was 8,000. When there is $200 in the economy, the money supply is going to be 1,600. So money supply increased or not? And when there is too much money supply, it is going to depreciate our value of currency. So what RBI will do, just to maintain the exchange value of rupee, RBI will suck out this extra 800 rupees from the market, and that is known as exchange stability, exchange rate stability. Because value of rupee will decrease, because supply of rupee is more in comparison to demand of rupee. That's why the value of rupee will decrease. Because of, it is not because of our region, it is because of the inflow of forex. So what RBI will do? RBI will suck out the extra liquidity of 800, as in our example, and the measures through which RBI suck out this extra liquidity, that is known as market stabilization scheme, and that is also monetary policy tool. We will discuss it in detail today's session itself. Okay, so now I am summarizing that objectives of our monetary policy. The main objective of monetary policy of RBI is to have the price stability in the economy. Second is to have the economic growth with price stability in the economy. Not only this, to ensure full employment and to maximize the output. Not only this, the other objective is to have the exchange rate stability in the economy. These are the main objective of monetary policy of RBI. Now we are going to proceed further. If there is any doubt, let me know. Good morning, dear. Good morning. If there is any doubt, let me know. So can we proceed further? So now we are going to focus types of monetary policy. When we talk about the types of monetary policy, there are two types of monetary policy. One is known as expansionary monetary policy, other is known as contractionary monetary policy. I am going to repeat once again. The monetary policy can be categorized under two categories. One is known as expansionary monetary policy, other is known as contractionary monetary policy. What is the meaning of expansionary monetary policy? The meaning of expansionary monetary policy is that RBI want to increase the money supply in the economy. And why RBI want to increase the money supply in the economy? Because there is scarcity of money supply. Because there is scarcity of money supply, that's why RBI want to increase the money supply in the economy. And how RBI will increase the money supply? RBI will increase the money supply by reducing the interest rate in the economy. By reducing the interest rate in the economy. So, when there is scarcity of money supply, that means money supply is less than required, then there is slowdown in the economy. And in order to increase the economic growth rate in the economy, RBI will increase the money supply in the economy. And how RBI will increase the money supply in the economy? By reducing interest rate in the economy. By reducing interest rate in the economy. By reducing repo rate, by reducing reverse repo rate, by reducing bank rate, by reducing SDF rate, by reducing CRR, by reducing SLR. The RBI want to increase, and that type of policy is known as expansionary monetary policy. So, when RBI is going to adopt the expansionary monetary policy, RBI is going to adopt expansionary monetary policy when there is slowdown in the economy. When there is slowdown in the economy, RBI will adopt expansionary monetary policy, and under that expansionary monetary policy, RBI will reduce the interest rate in the economy, so that loans for the business sector will be cheaper, which will motivate them to take loans and to do business activities, which will increase the economic growth rate in the economy. So that type of policy is known as expansionary monetary policy. And we discussed it already. So now we are going to discuss the other type of monetary policy, that is contractionary monetary policy. When the RBI is going to adopt the contractionary monetary policy, RBI is going to adopt the contractionary monetary policy when there is more money supply in the economy, more than required money supply in the economy, which is going to lead inflation in the economy. Because of more money supply in the economy, the rate of increase in aggregate demand is more than rate of increase in aggregate supply, which is leading to inflation in the economy. In that condition, RBI try to reduce money supply in order to contain aggregate demand in the economy. And how RBI do that? RBI do that by by increasing interest rate in the economy. So, when there is more money supply in the economy, which lead to inflation in the economy. In that condition, RBI is going to increase interest rates in the economy. RBI is going to increase repo rate. RBI is going to increase reverse repo rate. RBI is going to increase bank rate. RBI is going to increase marginal standing facility rate. RBI is going to increase CRR. RBI is going to increase SLR. So that type of monetary policy is known as contractionary monetary policy. That type of monetary policy is known as contractionary monetary policy. If there is any doubt to anyone, let me know. Shall we proceed further? Now, we are going to discuss the tools of monetary policy. What are the tools available with the RBI through which RBI increases or decreases the money supply in the economy as per the need of hour? So we are going to discuss those tools. So the tools of RBI can be categorized under two categories. One is known as quantitative tools, other is known as qualitative tools. One is known as quantitative tools, other is known as qualitative tools. Quantitative tools are those tools with the RBI through which RBI want to increase or decrease the money supply or overall money supply in the economy. That type of tools are known as quantitative tools. I am going to repeat once again. Quantitative tools are those tools through which RBI want to increase or decrease money supply as per the need of hour in overall economy. Those tools are known as quantitative tools. Overall money supply is going to be reduced in all the sectors. Whatever money supply is there, suppose 10 lakh crore. 10 lakh crore is the money supply in the economy. So RBI want to increase or decrease this 10 lakh crore as per the need of hour. If there is inflation, RBI will decrease, and RBI want to decrease it at 8 lakh crore. So that is going to be contractionary monetary policy. And how RBI will do? By increasing the interest rate. But the monetary policy which focus on overall money supply in the economy, that is known as quantitative tools. What is the qualitative tools? Qualitative tools are those tools through which RBI transfer the liquidity or RBI transfer the money supply from one sector to another sector. Not overall money supply. That means overall money supply in the economy is quite good. It is okay, but some point of time in one area or one sector of economy there may be more money supply, whereas in other sectors there may be scarcity of money supply. So through the qualitative monetary tools, RBI is going to transfer the money supply from the sector in which there is surplus of money supply to that sector in which there is scarcity of money supply. Those type of monetary policy is known as qualitative monetary policy. Qualitative monetary policy. Shall we proceed further? Now we are going to proceed further. We are going to discuss, first we will discuss the quantitative tools, then we will focus on qualitative tools. So when we talk about the quantitative tools, we can categorize the quantitative tools as CRR, cash reserve ratio, SLR, statutory liquidity ratio, open market operation. Let me first tell you what are the quantitative tools. Bank rate, other is the liquidity adjustment facility. Through this liquidity adjustment facility, there is two things. One is repo transaction, other is reverse repo transaction. And through repo transaction and reverse repo transaction, that is repo rate and reverse repo rate. And there is marginal standing facility, there is market stabilization scheme, and there is standing deposit facility, SDF. It is latest one. And under the qualitative tools, there is marginal requirement, and there is moral suasion, and there is selective credit control. And we will discuss all these one by one, and we will understood it in very length and width. So let me summarize once again that quantitative monetary policy, the tools of quantitative monetary policy are in the form of CRR, SLR, in the form of open market operation, in the form of bank rate, in the form of repo rate, in the form of reverse repo rate, in the form of marginal standing facility rate, in the form of market stabilization scheme, in the form of SDF, standing deposit facility. And under the qualitative tools, RBI has marginal requirement, other is moral suasion, and other is. So now we are going to proceed one by one. First we will try to understand the quantitative tools, and under the quantitative tools, first of all we will discuss the cash reserve ratio. Cash reserve ratio. What is the meaning of cash reserve ratio and how it works for increasing or decreasing the money supply in the economy, we will discuss. So what is the meaning of cash reserve ratio? The meaning of cash reserve ratio is that certain percentage of their total deposits the commercial banks has to maintain with RBI. Under the CRR requirement, a certain percentage of their total deposits commercial banks has to maintain with RBI, and that certain percentage is known as cash reserve ratio, and this certain percentage is decided by RBI on the basis of need of hour. Suppose 100 rupees is the total deposit of Axis Bank and SLR rate is 5%. This is hypothetical situation. Suppose SLR rate is 5%. So out of 100 rupees, 5 rupees the Axis Bank has to maintain with RBI. That is known as, this 5% is known as CRR. So if RBI want to increase the money supply in the economy, and when RBI will increase the money supply in the economy, when there will be slowdown. So when there is slowdown, so RBI is going to adopt the expansionary monetary policy. In that condition, what RBI will do? RBI will reduce this CRR rate. So RBI will, suppose RBI reduce the CRR rate 5% to 3%. So now the Axis Bank has to maintain only 3 rupees and 97 rupees they can lend out. So that will increase the money supply to 2 rupees. Okay, so this is the meaning. On the opposite, when RBI want to control the inflation, what RBI will do? RBI will increase the CRR limit. and through that the commercial bank will be in position to lend lesser amount because of increase in CRR rate. So that is the CRR, and how it works we discuss. If there is any doubt, let me know. Now we are going to discuss SLR. What is the meaning of SLR? SLR is statutory liquidity ratio. Similar, same thing. The same thing is in terms of that certain percentage of their total deposits commercial banks has to maintain with itself in specified liquids, and those specified liquids are, one is government security, other is cash, other is gold, and other is excess reserves. Excess reserves. My dears, I am going to repeat once again that SLR is the rate which is being maintained by the commercial banks with itself in response to their total deposits with itself in specified liquid assets, and those specified liquid assets are government securities. That means they can maintain SLR in the form of government securities, they can maintain SLR in the form of cash, they can maintain in the form of gold as well, and they can also maintain in the form of excess reserves. So in these specified liquid they can maintain SLR with itself. Suppose we will discuss it with an example. Suppose again 100 rupees is the total deposit of SBI, and the rate of SLR is suppose somewhere 12%. We are talking about hypothetically it is 12%, something around 12%. So that means on 100 rupees 12 rupees commercial banks, that is SBI, has to maintain with itself, and with itself 12 rupees has to be maintained. They have the opportunity to maintain in government security, they can maintain in cash, they can maintain in gold. So that means 12 rupees they will maintain 12 rupees, 8 rupees in the form of, this is hypothetical, and why I am talking about like this I will discuss. 8 rupees they will maintain in the form of government security, and 2 rupees they will try to maintain in cash, and 2 rupees or 1 rupees they will try to maintain in gold, and in 1 rupees they will try to maintain in excess reserve. That maximum amount of SLR they want to maintain in the form of government security, because if they will maintain in cash, that will decrease their spread. If they will maintain in gold maximum amount, although they can maintain, but RBI demotivate the commercial banks to maintain SLR in gold or cash, because if they will maintain maximum amount in cash, that will reduce their spread, because they can lend out lesser cash to the market. And if they will maintain in gold, we are not gold import gold, and in that condition we have to import the gold, and which will that means debalance our balance of payment, which will further widen our current account deficit. We will discuss when we will discuss the BOP. So that's why most of the maximum amount of SLR is being maintained in the form of government securities. So this is the meaning. So that means how it works as the tool for monetary policy for reducing money supply or increasing the money supply as per the need of hour. If RBI want to increase the money supply, RBI will reduce the SLR rate. If RBI want to increase the money supply, RBI will reduce the SLR rate. Whereas if RBI want to decrease the money supply in the economy, RBI will increase the SLR rate. And by increasing or decreasing the SLR rate in the economy, RBI maintains the required amount of money supply in the economy. Now, we are going to proceed further and we are going to discuss the next concept, that is open market operation. Open market operation. What happened under the open market operation? RBI sold out or purchased the government security as per the need of hour in the open market operation. In open market operation, RBI either sold out or purchased the government security as per the need of hour. Okay, let me tell you people that in economics or in business sectors, that transfer of funds always takes place on the basis of collateral. On the basis of collateral. Collateral is nothing but an asset which acts as the security for the loan. Good morning dear Hemant, good morning. We are discussing open market operation. So let me tell you that whenever the transfer of funds in the economy takes place, it always takes place on the basis of collateral or security. That collateral is nothing but asset which acts as the security, in response to the loan. And I will explain it with a diagram. Suppose this is RBI and this is SBI. So SBI want to take loan from RBI. So the funds will transfer from RBI to SBI, and collateral or security will transfer from SBI to RBI. That security may be government security, that security may be private security. When commercial banks takes the loan from RBI against the private security, they take loan at the bank rate. When they take the loans against the government security, they take the loan at repo rate. And they take the loans from RBI for longer term at bank rate, and they take the loans from RBI, that is repo rate. But that be the case of bank rate or be the case of repo rate, always the transfer of funds takes place on the basis of security. That security may be private security or that security may be government security, and government security is known as gilt-edged security. So our purpose is to understand that how open market operation takes place. So under the open market operation, as I said, that the transfer of funds always takes place on the basis of security, and the transfer of funds are opposite to the transfer of security. If the security will transfer from RBI to SBI, if security funds transfer from RBI to SBI, security will transfer from SBI to RBI. Okay, so what RBI is doing under this? RBI is going to purchase the government security. RBI is purchasing the government security, and when RBI is purchasing the government security, what is going to be? Funds are going to transfer from RBI to SBI. So money supply is going to increase. So when RBI want to increase the money supply, RBI will purchase the government security. When RBI will want to increase the money supply under the open market operation, if RBI want to increase the money supply, RBI will purchase the security. So security will transfer from commercial banks or financial institutions to the RBI, or funds will transfer from RBI to commercial banks or financial institutions. Whereas if RBI want to reduce the money supply, RBI will sold out the government security. Sorry. If RBI want to reduce the money supply, again this is RBI and this is SBI. Now RBI want to reduce the money supply. So in order to reduce the money supply, that funds should transfer from SBI to RBI. So funds will transfer from SBI to RBI and security will transfer from RBI to SBI. So when RBI want to reduce money supply, RBI sold out security or government security. When RBI want to increase money supply, RBI purchase security. So under the open market operation, as per the need of hour, the RBI purchase or sold out the government security in order to increase or decrease money supply in the economy. Now, I am going to proceed further and I am going to discuss other tools. Other is bank rate. Other is bank rate. What is the bank rate? As I said, that transfer of sorry. As I said, that transfer of funds takes place on the basis of security only, and bank rate is the rate at which commercial banks takes the loans from RBI for the longer period against the private security. So that means if commercial banks needs the fund for longer period at the same time against the private security, that may be CP, that may be CD, that may be commercial paper, that may be certificate of deposit, that may be trade bill. So against the private security, if RBI takes the loan for longer period of time, they takes the loan at bank rate. So when RBI want to reduce money supply in the economy, they increase bank rate, which demotivates because cost of borrowing. When they increase bank rate, the cost of borrowing for commercial banks increases, which demotivates them to take borrowing, which decreases the money supply. Whereas when the RBI want to increase money supply in the economy, RBI decreases the bank rate, which reduces the cost of borrowing of commercial banks, as a result, which motivate them to take loans, which increases money supply. So when RBI want to increase money supply, RBI reduces the bank rate, that is known as expansionary monetary policy. On the opposite, when RBI want to reduce the money supply, RBI increases the bank rate, which is known as contractionary monetary policy. Now, we are going to discuss the liquidity adjustment facility. We are going to discuss the liquidity adjustment facility. What is the meaning of liquidity adjustment facility? The meaning of liquidity adjustment facility is there is repo transaction and reverse repo transactions through which RBI increases or decreases liquidity in the economy, and these are the tools which are known as policy tools. Nowadays, whenever RBI want to increase or decrease the money supply, RBI is frequently taking resort of liquidity facility, liquidity adjustment facility through repo transactions or reverse repo transaction, which takes place at repo rate and reverse repo rate. And it is very important, and how it works, be very clear about it. I am going to explain it like anything, and it will be crystal clear. Okay, so listen me very carefully. So when, as I said that liquidity adjustment, under the liquidity adjustment facility, central bank seeks to adjust the short-term fluctuation in liquidity in the economy through repo or reverse repo transactions. And what it means, we will discuss. We will discuss. And this repo transaction and reverse repo transactions takes place. This repo transactions and reverse repo transactions takes place at repo rate or reverse repo rate. Now we are going to. So first we will define that what is the meaning of repo transactions, what is meaning of reverse repo transaction, and how repo transactions and reverse repo transactions are instrumental for increasing and decreasing the money supply as per the need of hour. Please try to understand. This should be, that means this should be that means you people's query, that when we increase the repo rate, then also money supply reduces. When we decrease the repo rate, reverse repo rate, sorry, when we increase the repo rate, then also money supply reduces. When we increase reverse repo rate, then also money supply reduces. How it happens? Because repo rate and reverse repo rate are different. So how the same result is going to be? We will understood it today's lecture, how it happens. Please listen me and listen me very carefully. This is very important, and how it works, it is very important. What is repo transactions? First let me read it for you people. What is repo transaction? Under the repo transaction, central bank purchases government security from banks or financial institution with agreement to sell them back predetermined rate and date. Okay, so what happen in case of repo transactions? That government RBI purchases, be very clear, purchases the government security. When RBI will purchase, so there should be increase in money supply. So the repo transactions, through repo transaction, there should be increase in money supply. I am going to make figure for you people. Please listen me very carefully. This is RBI and this is, suppose, commercial bank SBI. This is SBI, commercial bank, and this is RBI. Let me change the pen color. This is purchase, when RBI is going to purchase the government security, so the security will transfer from SBI to RBI. Security will transfer from SBI to RBI, and funds will transfer from RBI to SBI, and that will lead to increase in money supply. So through repo transactions, be very clear, through repo transactions, money supply should increase, because RBI is purchasing government security. When RBI is purchasing, the money supply is going to be transferred from RBI to commercial banks. So repo transaction will be instrumental for increasing money supply. But what is repo transaction and why? Through the repo rate, we reduce, increase in repo rate, we reduce money supply. For that, we need to understand the repo rate. What is the repo rate? Repo rate is the rate of interest at which central bank purchases. The rate at which central bank purchases government security and lend out to the financial institutions. The rate at which central bank purchases the government security, or rate at which RBI gives loan to commercial banks against government security. Repo rate is the rate at which RBI gives loan to the commercial banks. So when repo transaction takes place at repo rate. So when there will be increase in repo rate, so that means cost of borrowing of commercial banks from RBI increases. Cost of borrowing, since because of increase in repo rate, the cost of borrowing for commercial banks increases, which reduces money supply. So we can say that, please dears, listen me, we can say that increase in repo rate demotivate repo transactions, because it increases cost of borrowing for the commercial banks, which demotivates the repo transaction. As a result, money supply in the economy reduces. I am going to repeat once again. What is repo rate? Repo rate is the rate at which repo transaction takes place, or in other words, we can say that repo rate is the rate at which commercial banks takes the loan from RBI against the government security. So when repo rate is going to increase, the cost of borrowing of commercial banks from RBI is increasing. When it is increasing, that demotivates the commercial banks to take loan from RBI. That's why when there is increase in repo rate, decreases the repo transactions. And when there is decrease in repo transaction, money supply decreases. So increase in repo rate demotivates the commercial banks to take loan from RBI, because it increases their cost of borrowing. That's why money supply in the economy reduces. Now, we are going to discuss the reverse repo transaction and reverse repo rate. What is reverse repo transaction? Reverse repo transactions are the transaction through which central bank central bank sold out short term government security to the banks. Be very clear. Let me make it a diagram. This is RBI and this is SBI. This is SBI, this is RBI. So what RBI do? RBI sold out the government security. So the security will transfer under the reverse repo transactions. Security will transfer from RBI to SBI and funds will transfer from SBI to RBI. Funds will transfer. That will repo transaction will be reverse repo transaction will be instrumental for decreasing the money supply. Reverse repo transaction will be instrumental for reducing the money supply. I am going to repeat once again. Under the reverse repo transactions, what happened? RBI sold out the government security. Yeah, RBI, Suman, Aman Kaushik. Yeah, definitely. RBI controls the money supply through bank rate, but nowadays RBI is not taking resort of bank rate. Rather, RBI is taking resort of repo rate and reverse repo rate. Aman, definitely RBI has the tool to increase the repo rate, to increase money supply through bank rate, but nowadays RBI is not taking resort of bank rate. Whenever there is long term, because if there is RBI want to maintain or adjust the liquidity for shorter period, they are taking resort of repo rate or reverse repo rate, not bank rate. But if they want to, they can take the resort of bank rate as well. So this is about. Now we are going to proceed for our discussion. Now, as I said, reverse repo transactions, under the reverse repo transactions, RBI sold out the government security. So security will transfer from RBI to commercial banks and funds will transfer from commercial banks to RBI, which will be instrumental for reducing the money supply in the economy. So reverse repo transactions will be instrumental for reducing the money supply in the economy. Now we have to understand the reverse repo rate. What is reverse repo rate? Reverse repo rate is the rate at which reverse repo transaction takes place, or reverse repo rate is the rate at which commercial banks park their money with RBI. Reverse repo rate is the rate at which commercial banks park their money. Never say that RBI takes borrowing from commercial banks. They never take loans from commercial banks. Rather, commercial banks park their extra liquidity. Our wording should be that commercial banks park their extra liquidity with RBI. The rate at which they park their extra liquidity with RBI, that is known as reverse repo rate. Reverse repo rate. So be very clear that we cannot use the word that commercial banks takes the loan, RBI takes the loan from commercial banks. Rather, we should have to use the rate at which commercial banks park their money with RBI. So the reverse repo rate is the rate at which commercial banks park their money with RBI. So what happened? So what happened? When there is increase in reverse repo rate, what will be? It will lead to increase in interest of banks, because whatever they are going to park, whatever money they are going to park with the RBI, they are entitled to get interest on that. So if reverse repo rate will increase, their interest rate on the parked money will increase. If their interest rate with park money will increase, that means they will be motivated to park more money. That commercial banks will be motivated to park their more money with RBI, and that's why it will reduce the money supply in the economy. So let me summarize that when there will be increase in reverse repo rate, that means that it will increase the interest rate on parked money of commercial bank. It will motivate the commercial banks, it will motivate the commercial banks to park more amount of money with the RBI. As a result, money supply in the economy will reduce. So when there is increase in reverse repo rate, money supply reduces. When there is increase in reverse repo rate, money supply reduces. So this is about the quantitative tools. Another one is marginal standing facility. What is the meaning of marginal standing facility? Under the marginal standing facility rate, that commercial banks can take loans of certain percentage, that is up to 2% of their total deposit. Under the marginal standing facility, the commercial banks can take loans up to 2% of their total deposits if there is any mismatch between their total assets and total liability, by plunging government security with RBI. And when they are going to plunge the government security with RBI, that is not going to reduce their requirement of SLR. So that is the marginal standing facility. So when RBI increases the marginal standing facility rate, so that means that demotivates the commercial banks, to take loan from RBI. That as a result, money supply in the economy reduces. So, and this marginal standing facility rate is also known as penalty rate. Now we are going to discuss the market stabilization scheme. Under the market stabilization scheme, what happened? Under the market, RBI sell the special government security to suck out the extra liquidity because of forex, because of inflow of forex. As we discussed, suppose earlier there was $100 and $1 equal to 80 rupees. So total money supply in the economy was 8,000 rupees. Now suppose because of inflow of forex there is $200 and $1 equal to 80 rupees only. So now total money supply is 1600, and because of that 1600 rupees, it will reduce the exchange rate of rupee. It will depreciate the exchange rate of rupee. So because of that, RBI is going to suck out the extra 8,000 liquidity from the market, and for that RBI sold out the special kind of government security. When RBI is going to sold out a special kind of government security, the security will transfer from RBI to commercial banks, and funds will transfer from commercial banks to RBI, and through that RBI suck out the extra liquidity from the market, and that type of scheme is known as market stabilization scheme. And under that, whatever liquidity is sucked out by the RBI from the market through the market stabilization scheme, that is maintained by RBI in a separate account, and on that RBI do not pay the interest rate, rather Ministry of Finance pays the interest rate. Okay, that is the market stabilization scheme. Now we are going to discuss the standing deposit facility. What is standing deposit facility? This standing deposit facility concept is latest one, and it was introduced in April 2022. So under this, that means same thing like reverse repo rate. Under this also, that commercial banks park their money with RBI, extra liquidity park with RBI. The rate at which the commercial banks park their extra liquidity with RBI is known as standing deposit facility. That only difference is that under the reverse repo rate or reverse repo transaction takes place when RBI want to, but in case of standing deposit facility, they are open throughout the week. Any day, if they feel that they have the extra liquidity, they can park their extra liquidity with RBI, that is known as standing deposit facility. That is all about our today's lecture. Today we finish here only. We will meet tomorrow. Thank you very much, dears. Thanks a lot. If there is any doubt, let me know. If there is any doubt, let me know. So today we finish here only. Thank you very much, dears. Thanks a lot.